I think the first thing to talk about is ultimately what happened with the Fed last week, because we're not going to hear from the Fed for a little while moving forward. Their next meeting isn't until May, and despite all of the attempts by various Fed officials to bring their remarks to the public, hit the airwaves, hit the news wires, those remarks aren't really leaving an impact on any particular asset class, which a few years ago, people like James Bullard, the St. Louis Fed president, would open his mouth and the 2-year yield would freak out. It's quite a different environment right now. So what happened last week? The Fed did hold rates where they were expected to. No surprise there, 1% chance according to the 3-month SOFR rates, the SR3 contracts that you can see on your very platform there. Nothing was anticipated, but they did make some changes in their summary of economic projections. They did boost the inflation forecast just for this year. They also reduced growth expectations and labor market expectations moving forward for this year and into the future. And I think that's a really important quality for traders to understand about what the Fed's reaction mechanism is right now to this tariff uncertainty. The Federal Reserve's own literature, as is publicly available, having read through it myself over the past 2 weeks, the Fed does not necessarily treat a tariff as a consistent rise in inflation. Instead, if it sees inflation going up, a tariff represents a one-time price rise, and then inflation continues along its previously scheduled path. And so from the Fed's point of view, they're not so concerned with inflation, and thus there's no real need for a rate hike. Any such inflation would be, as Fed Chair Powell himself said, transitory, fun word choice there. The real concern is what happens to economic output thereafter, and that tends to decline. So ultimately, a Federal Reserve is pointing the path towards a more dovish policy outcome, regardless of what happens in the near-term inflation outlook. They see these bigger issues lurking around the corner that are going to weigh on growth. So over the past week, what's happened? We've seen a big rebound here in stocks. Obviously, there's been an enormous volatility crush. It all comes on the other side of OPEX. But we have a month-and-a-half window now where the Fed is effectively on the sidelines. And all these data releases that may otherwise stir a market movement, what's one single non-farm payrolls report? It's just one of two before the next Fed meeting. And who cares anyhow? Non-farm payrolls, we're not ultimately going to know the true trajectory of that until the tariff rates are set into play on April 2nd. So who even cares? Tom, I have to say, in my entire adult life of trading and working in financial markets professionally, I feel right now the Fed is at its lowest point in terms of influence on markets. I'm not sure about how you feel, but I'm curious, have you found that the Fed is without influence in these markets, or do you always feel that way?
Well, yeah, you know, my take on the Fed is very different than most, but I think the Fed is so. I think Jay Powell is actually is good at what he does, really good at what he does, and I think that in order for the Fed to maintain both its sanity and its importance, the Fed laying low right now is the perfect move. It's exactly what the Fed governor, what the Fed chairman should be doing, because this is an administration that likes to play politics with politics. This is an administration that likes to use different entities as political pawns. And what the Fed's doing right now is they're staying away from all the games, which is the right thing to do. Stay away from the games. Don't bring attention to yourself. You serve the role, as I've mentioned this before, it's a role of catastrophic insurance, of which it has an incredibly high deductible. So essentially, the Fed takes a step back. They're only needed if something breaks or if something gets ugly. And in the interim, their role is to be like the role of a great waiter. You know they're there, but you don't have to see them or hear them.
Okay.
You know, I know that sounds a little like weird, but that's how I view the Fed role is, you know, they're there when you need them. They're not there when you don't need them, and they're not there to play politics, and they're not there to get involved and to let anybody use them as a pawn. And I think that is a real challenge in the current administration, it's very much a challenge, and because they're not, this is not a Fed that was chosen by this administration. Hence, the loyalty factor that every other department is required to have is not there. So that's why they understand that the ground they're on, even though it's an independent organization, they're doing the right thing right now, which is providing a service for protecting the economy, which I think is really important, and protecting the integrity of our economy. And I think they're doing exactly the right thing. I don't think they should have taken any action, and I think that also by the comments they made, I don't think they have to do anything.
I'm very much in agreement. When there's an opportunity for speculation around what the Fed is or is not going to do, it's usually when there's a wide gap between the prescribed path of interest rates, the dot plot that the Fed has laid out, and the actual market pricing. When you look to the Fed funds futures or 3-month SOFR contracts, an example of this is like last August, when you saw that the market was pricing in 6 potential rate cuts through the end of the year, and a 73% chance of an emergency 25 basis point rate cut within 1 week, thanks to that big sell-off that culminated on August 5th, that Monday.
Yeah.
The Fed obviously wasn't coming out and saying we have to start cutting rates again, but the market was moving to a place where we're looking at 3, 4, 5 rate cuts in excess of what the Fed has actually outlined. And so from that point of view, you have a big opportunity for bond markets to come back in, for gold prices to move, for stocks to move, because we need to narrow and converge. The convergence has already happened right now, Tom. The Fed's telling us we're going to get 100 basis points worth of cuts through the end of next year. Right before I came on the show, I checked the SOFR curve as well as Fed fund futures. They're priced at 101 basis points through the end of next year. The market is sitting on top of the Fed right now. So without that gap between expectations and reality, and really not much by way to move our expectations outside of the tariff conversation, the Fed effectively is a dead trade right now. There's nothing to do there. So I think that, for a macro person like myself, that's difficult to admit. But for traders who look to the Fed as a guidepost or a catalyst in this market, I think you're going to be a little bit disappointed here for the next few weeks. It's time to move on.
Well, I'm already not disappointed because this morning we got bonds down into the 115 handle, which is where we wanted to buy them. So we bought them, and so far so good. So we'll see what happens.